Welcome everyone. Focus today will be on interest expense restriction. We want to discuss about interest expense restriction in Kenya. This is what also we refer to as thin capitalization. Thin capitalization. So we need to be clear on these two terminologies and how they come about. What is this interest expense restriction, or what is this thin capitalization? So when we talk about a company being thinly capitalized, what are we saying? Capitalized. What are we saying? So the history to it is that companies have two main ways of raising capital. So there are two main ways of raising funds. So companies raising funds can be done in two ways. So number one can be done by way of equity. So this is where the owners of the business bring in cash through cash capital injection. What we are saying is that the owners bring in their own money into the business through cash injection. And the return to this, so the return here, the return therefore is in the form of dividends. The return is in the form of dividends. And dividends is a post-profit item. It's a post-profit item, meaning the incomes have been offset against, so this way we're saying the revenue has been offset against the expenses which were incurred, the allowable expenses which were incurred to raise this revenue. Then of course we get the profit. This profit is what we subjected to tax, and of course now post-tax we can consider now post-tax the appropriation of the profits, which is what we refer to as dividends. Now there is a second mode of raising funds, which is now debt. So debt is, of course, getting money from other parties or still from the shareholders, but now the return here is in the form of interest. And this interest then becomes our subject of discussion today. So why is it a concern to a tax jurisdiction? Why is it a concern to a tax jurisdiction? So the reason is because this interest expense is an allowable deduction for tax purpose. This interest expense is an allowable deduction for tax purpose. So before we proceed then to discuss the issue at hand on interest expense deductibility, let's first appreciate these two, this first aspect and this second aspect. So these two aspects then form what we refer to as the capital structure of a company. Say that if you are to look at the balance sheet, we have in the statement of comprehensive income, the balance sheet. So the statement of financial position, you note we have first the assets. So we have the assets. So we have here the non-current assets and the current assets. These two then forms the total assets. Then on the other side, the equity side, the financing side. So on the financing side, this is what we refer to as the capital structure, the financing. So financed by. So here we have, it can be financed by equity. An equity in this case is the share capital, so issued share capital, plus now the retained earnings. And of course now the other side will be the debt, which is now borrowings. And these borrowings could be in the form of, say, bank loan. It could be in the form of overdraft. It could be in the form of a Shylock loan. It could be even from Shylocks. It could be even from the shareholders, but which is subjected to interest. So this then becomes our issue. So we need to appreciate that structure, because as we move on, for us to be able to deal with this issue of thin capitalization, we need to be clear on the capital structure, how the capital structure looks like. And this is basically, we're saying the equity component and the debt component. So we've said the concern for a tax jurisdiction is the issue of the deductibility of this interest expense. So what we mean is that if you are to look at the statement of comprehensive income, the P&L, you find that we have the sales, then we have the cost of sales, which gives us the gross profit. Now, here we have expenses which are incurred in generation of this revenue here. So what we're saying is that you find interest expense coming in here, and this interest expense, then we are saying it is an allowable deduction. So what it does is that it reduces the net profit, and this net income is what is assessed for tax. So you see what this interest expense has done, it has reduced this base for purpose of tax, because once we then adjust for the non-deductible items, then we arrive at the taxable income from adjusting these reported profits. Now, this is the issue, because you realize what this interest expense has done, it has reduced this base, this taxable, this net income, the net profit, which will be then assessed for tax. So now what jurisdictions have done, they've come with a way to try and restrict this. And the reason for restricting is because most organizations then tax plan around the composition of debt and equity in their capital structure. So companies, organizations have done, what they've done is to utilize more of debt and increase the interest. And in so doing, what they've done, they've reduced their net profit. And especially for say multinationals, they would make this arrangement to then take advantage of this avenue, this deductibility of the interest expense. So what are jurisdictions done to manage this tax planning avenue? So there are methods of interest restrictions. So methods to restrict interest deductibility. So this aspect of deduction of the interest here. So one method is what we refer to as the arm's length method. So what the jurisdictions would do, so assume this company is company A. So we will look for a comparable. So arm's length. So what we do, we look for a comparable, say company B. This company B should be similar to company A in all respects, in all parameters, in all factors. So we look at the capital structure for B and look at the debt level for B, considering that they have the same establishment, same size, and same factors. So we just use it as a benchmark, or we get an average of the debt level for companies under the same stature. So if the debt level in company B, a complete comparable, a perfect comparable, is at 50 million, and we find that company A, the debt level is 100 million, meaning company A is using more of debt than equity. And so what we will do, we will restrict the interest amount to be deducted to the level of 50 million. So for company A, we will only allow, so we'll allow interest on the debt to the level of 50 million and disallow the rest. So that is one way of restricting this interest, by getting a perfect comparable to assist in coming up with the amount to be disallowed. So number 2 is what we refer to as the ratio method. So the ratio method, you find the jurisdictions could come up with a ratio. So the say ratio maybe is 2:1, where we're saying the debt level should not be more than 2 times the equity. Or some jurisdiction could come up with a ratio of 3:1, where we're saying the debt level should not go beyond 3 times the equity. So if it goes beyond the 3 times, then that interest on debt above the 3 times will be disallowed. The interest above the 3 times of equity will be disallowed. And so the formula could look like this. So this is the debt minus 3 into the equity. So sorry, the equity, in this case share capital plus the retained earnings over the debt level times the interest expense. Say that the resultant then is what we refer to as the interest which will be disallowed, because it is the interest on the debt level which is over 3 times the equity, which is what we're saying we will disallow that resultant interest amount. Now, the third way of restricting interest is what we refer to as stripping method, where jurisdictions then come up with a way to cap the interest expense being deducted. So, for example, jurisdictions could come and say, let's allow only 30% of EBITDA. So this is 30% of earnings before interest, tax, depreciation, and amortization. So this way, then it's capped to that level. So any interest above the 30% of EBITDA will be disallowed. And this is for Kenyan case, in the year 2023, the Finance Act then introduced interest expense restriction at 30% of EBITDA. So it's a way of coming up with a cap to address the interest expense deductibility. So what happens is that for that year then, and the main reason here is to compel companies to procure loans or debt towards improving the earnings, towards increasing the earnings, which is taxable, the taxable earnings. So then we will, in this case, if the company is in a loss position, then there will be no interest expense which will be allowed. If the company is in a loss position, then there will be no interest to be allowed. So this is what happens. We'll only allow 30% of EBITDA. Thank you, and continue subscribing and looking out for more content. Thanks.